Hello, and welcome to episode 128 of the REconomy Podcast, where we discuss economic issues that impact real estate, housing, and affordability. If you find this type of real estate economic discussion valuable, please be sure to hit the like button and subscribe to help us grow this podcast. I'm Odeta Kushi, Deputy Chief Economist at First American, and here with me is Mark Fleming, Chief Economist at First American. Hey, Mark. Even though this episode is publishing just a few days after Halloween, it is our Halloween episode. So we're taking a flashlight to some spooky headlines and questioning whether the housing market is actually haunted. So I know, exciting. From prices are about to crash to foreclosure wave incoming to sales are dead forever, we'll try to separate creaks in the floorboards from actual structural cracks.
Hey, Odeta, perfect timing for myth hunting and busting. And look, when the market seems haunted, I gotta do this. Who you gonna call?
Here we go.
Yes, oh yes. If there's something strange in the neighborhood, who you gonna call? Ghostbusters, of course, 1984. Okay. Obligatory? Maybe only? Maybe not only first? Maybe there's more? 80s reference achieved.
I kind of walked right into that one,
You
to be
did,
honest.
indeed.
It's perfect and ripe for a Ghostbusters reference.
Exactly.
But I would say today we're more like Bubble Busters than Ghostbusters. And here's our path through the haunted house. So first, why a house price slowdown isn't necessarily a bust. Second, what to make of distress and foreclosure chatter. Third, why sales remain low and what that really signals. So let's start with prices. Our very own seasonally adjusted First American Data and Analytics August House Price Index shows that annual house price appreciation has slowed for 20 consecutive months to the slowest pace since 2012. And of the top 50 markets we track, 21 of them had year-over-year price declines, with the most severe being San Francisco at 6.6% and Tampa at negative 5.9%.
Okay, so that means that the majority, in other words, 29 markets, still had positive annual appreciation.
Ever the optimist, Mark.
Mm-hmm.
That is true, with the strongest being Cleveland and Louisville at 7.4% and 6.7%, respectively.
And there's a strong regional variation happening in today's market. Traditionally, more expensive markets like San Francisco or pandemic darling markets like Tampa Bay are now experiencing price declines, while traditionally more affordable markets such as Cleveland are still growing. If we were to generalize these regional trends, we would say that the Northeast and the Midwest markets seem to be outperforming, while prices in Western and Southern markets are flat or, in many cases, even declining.
Right. And those price moderations or even declines are helping to make some of those previously overheated or super expensive markets more affordable.
That's right. House price deceleration, or in some cases a slow decline, is actually normal late cycle housing market behavior, not a portend of doom. The 2021-2022 market was white hot. Demand was pulled forward, supply was scarce, and price growth overheated. Now there are more active listings, a higher share of price cuts, and longer time on market, which are all consistent with a market adjusting, not collapsing.
And remember the buffers that cushion prices: strong homeowner equity, predominantly fixed rate mortgages, and still historically low resale supply relative to pre-pandemic norms in some markets.
So while headlines may focus on price declines, it's not a repeat of the global financial crisis house price crash, thank goodness, but rather a readjustment to a higher interest rate, slower paced market. Myth busted, and I believe that actually brings us to our second spooky myth.
It's actually a very good segue to our second spooky myth, because it's all about the "here comes the foreclosure wave" headlines. Yes, measures of distress have risen from the rock bottom levels of the pandemic era policy support. And you can find pockets, often where affordability is most stretched, which is the case for some FHA or VA loan borrowers, or where local economies have softened, showing higher delinquency and more foreclosure filings than a year ago. According to the September ICE Mortgage Monitor, the national delinquency rate fell by 2 basis points to 3.42%, now 6 basis points from the same time last year and 58 basis points below its September 2019 pre-pandemic level. And while there was a 23% increase in foreclosure starts in the third quarter compared to a year ago, they're still down 18% compared to the third quarter of the 2019 pre-pandemic level. So the number of loans in active foreclosure are up 18% year over year, but overall foreclosure volume is at about half of 2019 levels. FHA loans account for the majority of that rise, making up 38% of active foreclosures, roughly half of the annual rise in foreclosure starts, and 80% of the rise in active foreclosures.
Yes, but the report also says that even as there is an increase in distress among FHA loans, we are returning to more normal levels following several years of artificially low foreclosure volume. Recall that government-issued loans like the FHA and VA ones tend to serve more first-time and lower down payment buyers, so the average borrower has less equity and a thinner financial cushion. That means when budgets get tight, early-stage delinquencies show up more in these lending programs.
Okay, but this isn't necessarily a sign of systemic risk. A national wave of foreclosures requires the dual trigger of loss of income and lack of equity. While the labor market has softened and prices, as we just described, has fallen in some markets, the unemployment rate remains historically low, while the equity cushion is significant. In fact, in the second quarter of 2025, U.S. households owned about $36 trillion in equity. That's a record high. Distress has increased in some pockets of the country, but we're still far from the gory scenes people imagine when they hear the word foreclosure. Though I should note that we are watching the labor market very, very closely because while it remains resilient, it can turn quickly. Layoffs are not showing any red flags right now, but that hiring rate is quite low. So we are stuck in this frozen labor market.
You know, Debbie Downturn just can't resist peeking around the corner of all the good things you just said.
She's always there.
She's always there. A good but potentially spooky point to be sure. And if we continue to see a cooling labor market, we do expect distress to increase, especially for people who bought at the top of the market in their geography and may be experiencing price declines. That's what we look for: job loss and lack of equity.
Very true. Now, before we move on to our third spooky topic, I should note that the Wall Street Journal recently wrote a piece about Florida's Cape Coral housing market, noting that it has the most homeowners underwater in the country, with nearly 8% owing more on their mortgages than their home is worth. That's thanks to a combination of lower house prices, lack of job opportunities causing a demand pullback, and higher insurance premiums. So again, we're not saying that there aren't pockets of the country experiencing some distress, but it's not a foreclosure wave due to the reasons we've mentioned.
Agreed. And so no house price crash, no widespread foreclosure wave. Maybe this haunted house is not really that scary after all.
Not so fast, Debbie Downturn here.
Of course.
Sales activity is the part of the haunted house where the floorboards really creak. Even as mortgage rates have eased, we're dealing with affordability constraints, economic uncertainty, and of course, that persistent lock-in effect. Most existing homeowners still hold rates well below current market levels, so new listings are arriving slowly.
True, but existing home sales specifically have bounced along the bottom of 4 million sales a year for a couple of years now, thanks to affordability and inventory constraints, and of course that lock-in effect. But a little positivity here in this scary haunted house. Affordability has been challenged by the surge in mortgage rates since 2022, but the trend more recently is encouraging. On a year-over-year basis, affordability is now improved for 6 consecutive months, because of slower price appreciation, income growth, and very modest moderation in mortgage rates. The affordability gains are broad, with 35 of the top 50 markets that we watch posting annual improvements, and 48 of the 50 improving over the previous month. No Debbie Downturn. No Debbie Downturn.
That is promising news. I'll give you that. And while home sales remain sluggish, that affordability boost from those modestly lower rates and income growth outpacing house price growth, it does seem to be lifting home sales on the margin. Contract closings on existing home sales increased about 1.5% in September. That's the highest in 7 months, a rate of 4.06 million. Similarly, Census Bureau's latest read from August on new home sales was about 800,000 seasonally adjusted sales. That's the fastest pace since early 2022. I do expect that number to be revised lower when the final data arrives, but it is an encouraging sign of some buyer life.
That's right. And we don't expect existing home sales to get back to normal this year.
Who's the Debbie Downturn now?
No, wait. Me? Never Debbie Downturn.
Sure.
I wasn't done. There is a but, of course, here. In a recent blog post, we wrote that historically, prior to the pandemic, existing home sales average about 4.1% of total U.S. households. By the way, I'm being very specific in my first digit.
It's important.
Exactly. Applying that long-term rate to today's total households implies an annualized pace of roughly 5.4 million annualized sales. That's about 35% higher than the current rate of 4 million. Pretty big gap. This reflects suppressed market participation rather than a shortage of potential movers. While we don't think that we'll reach that number of 5.4 million this year for sure, or even next, or maybe even the year after that, housing turnover still happens because life happens. Life events like marriage, expanding families, job changes, divorce, these always have and always will drive sales activity. Broad-based momentum back to normal will take time as life happens, affordability slowly improves, the rate lock-in effect eases, and economic uncertainty fades. So long story short, the housing market recovery is underway, but it's just beginning and it will take time.
All right, since we're in the thick of a seasonal change here, I'm going to think of it as a thaw and not a spring bloom. Now, activity will lift first at the margin, move-ready buyers, life event movers, and those facing rent versus own trade-offs. As spreads normalize and rate volatility cools and confidence improves, you'll see some upward momentum. You don't necessarily need a 5 handle on mortgage rates to see sales grind higher. What you need is stability, certainty, and inventory.
I think that's really our point. Sales grinding higher, which is definitely apt in this scenario, doesn't need to happen or will happen regardless of rates coming down or not. So let's recap. 1, price deceleration is not a bust. It's the market rebalancing as inventory and days on market normalize.
And number 2, distress has increased from pandemic-era floors, especially in government-insured segments that serve thinner cushion borrowers. But serious delinquencies and foreclosures remain low by historical standards, thanks to equity, a resilient labor market, and stronger underwriting.
And last but not least 3, the creakiest floorboards in this not-so-haunted house. Sales are still subdued by affordability and the lock-in effect, but there's evidence of a gradual pickup, especially as rates ease and builders bridging the gap. And if that sounds less like a horror movie and more like a choreographed dance number, we'll call it the housing market's thriller. 1982, greatest video of the MTV era when they played videos on MTV. And we got to add that to the REconomy playlist, which, by the way, listeners, is available on Spotify. Shameless plug done, and I'll see myself out.
I knew you were going to bring up thrillers somehow in this episode. But yes, let's close this up before the fog machine sets off the sprinklers. Okay, that is it for today. Thank you for joining us on this episode of the REconomy Podcast. If you have an economics-related question you'd like us to feature in the future, you can email us at economics@firstam.com. And as always, if you can't wait for the next episode, you can follow us on X. It's at Odeta Kushi for me and at Fleming Econ for Mark. Until next time.
Thank you for listening. You can find even more economic content at firstam.com/economics. This episode is copyright 2025 by First American Financial Corporation. All rights reserved.